Junior banker responsibilities during close, part 2. This is lesson 2 of class 2. In this lesson, we'll review the steps and procedures required by junior bankers prior to deal announcement and following deal announcement. Introduction. Part 2 of this lesson will review junior banker responsibilities following the deal announcement. The main responsibilities of the junior bankers include to ensure a timely and orderly closing process, to provide any and all analyses needed by senior bankers to support deal negotiations. Due diligence responsibilities. Once the LOI is executed, the deal is put on a strict timeline that clearly outlines all the necessary requirements to close. The bankers are responsible for their client hitting all the targets in a timely fashion. Many of these targets relate to due diligence items and the buyer's ability to successfully complete its confirmatory due diligence process. The buyer is going to need to complete a sweeping review of the target company that includes legal, tax, financial, and industry diligence. This review is long, in-depth, and requires a massive coordination of many different participants, such as the buyer's management team, the seller's management team, the buyer's legal, tax, and business advisors, and the seller's legal and banking advisors. Due diligence responsibilities continued. Junior practitioners will be responsible for facilitating meetings between these parties, which includes aligning schedules, taking notes during meetings, handling follow-up meetings, executing administrative tasks, and sharing supplemental data requests between parties. These responsibilities listed above may seem administrative in nature, but if the junior banker does not successfully tie these items together in an organized and timely fashion, then confirmatory due diligence will stall. If confirmatory due diligence is not completed, the deal could falter, and the buyer could ask for an extension. If an extension is asked for, this disrupts the closing process. And remember the famous saying in banking, time kills all deals. Financial analysis responsibilities. Providing further valuation guidance. The letter of intent does not always offer an exact purchase price. Even if the LOI does include an exact purchase price, it is never legally binding. The LOI purchase price is always dependent on further findings during confirmatory due diligence. Therefore, between executing an LOI and executing a purchase agreement, the junior bankers are hard at work creating guidance that can support valuation negotiations. Updating the financial model. The junior bankers need to ensure that the financial model present in the Round 2 VDR is updated with the most current information. This is incredibly important for early stage companies because several months could separate the time between the deal launching and the current financial negotiations. Therefore, the client's current run rate revenue could be significantly more attractive than it was at the beginning of the process. The banker wants the client to get credit for the client's most recent financial print, especially if the client is being valued on a revenue or EBITDA multiple. Financial analysis responsibilities continued. Updating market-based valuation analyses. The banker wants to ensure that any valuation guidance in the VDR shows the market's current pricing environment, not the environment of 6 months ago. This is especially true if market multiples have significantly moved since the deal's launching. Therefore, it is important that the junior bankers refresh relative valuation analyses that could change the client's valuation. Creating analysis around purchase price schedules. Junior bankers will also be working on the curation of supplemental financial schedules that outline and describe total purchase price considerations. This will help define the exact purchase price and the breakdown of considerations with respect to timing and forms of payment. For example, these calculations will tell the buyer how much it will pay and the breakdown of how much will be paid now versus later, or could be paid later if speaking about contingent considerations. And it will also tell the buyer and seller, how things will be paid, whether they'll be paid in stock, cash, or both. And it will discuss how much will be rolled over in seller equity. Working capital peg. One of the most important schedules that junior bankers will focus on is the working capital peg. This calculation has a direct effect on total considerations delivered at closing. Junior bankers are expected to provide financial analysis to substantiate or normalize the working capital assumption. The working capital peg is a calculation that shows the working capital levels necessary to maintain normal business operations. The peg is important because the purchase price is adjusted relative to the final working capital amount on closing day. For example, if the client presents a final working capital figure that is above the working capital peg, then the purchase price is increased by the difference, and vice versa if the final working capital figures are below the peg. Thank you for tuning in this lesson, and we look forward to seeing you at our next lesson, in which we'll cover senior banker responsibilities during close.